All right, let's pull back the curtain on a number that can seriously make or break a manufacturing company: overhead. And look, this isn't just about the simple stuff like factory rent or electricity. No, this is about the constant battle between a company's best guess at the beginning of the year and what they actually end up spending. And getting this wrong, it doesn't just mess up the books, it can hide some really serious problems and totally distort the true financial health of the entire operation.
So, to really get to the bottom of this, we need a clear plan. Let's lay out the roadmap for our journey today. Okay, we're going to start with the core problem. Why even estimate these costs in the first place? Then, we'll see what happens when those estimates clash with reality and how to figure out what that difference, or variance, is really telling us. After that, we'll explore the two main ways companies can clean up the books, and maybe most importantly, we'll see why the path they choose can dramatically change how you and I see their financial performance.
Okay, let's dive right in. First up, we need to establish the core problem that every single manufacturer faces. Why on earth do we have to estimate this stuff at all?
It seems logical, doesn't it? Why not just wait for all the real bills to come in? For the electricity, the supervisor salaries, the factory rent, add them all up, and then figure out your cost? Well, the problem, as you can probably guess, is all about timing. By the time all that info finally arrives, it's basically ancient history. Business just moves too fast. You've got to price a new product for a customer next week, or maybe bid on a huge contract today. You simply cannot afford to wait around.
So the solution to this whole timing problem is this really clever accounting tool called the predetermined overhead rate, or as everyone calls it, the POHR. This is the magic number. It's a rate that you calculate before the year even kicks off, all based on estimates. And this lets a company apply a little slice of that total expected overhead to every single product as it moves through the factory, giving them the real-time cost data they need to actually run the business.
And what's absolutely crucial to understand is that this is not a one-size-fits-all kind of thing. The POHR has to be tailored to the reality of that specific factory floor. So for example, in a plant where people are doing most of the work by hand, it makes total sense to base the rate on direct labor hours. But in a super automated bottling line, the real cost driver isn't the people, it's the machines. So you'd use machine hours. The whole point is to find whatever it is that has the most direct cause and effect link to those overhead costs.
Okay, so now we have our estimate, our PHOR. It's time to see what happens when that estimate collides head-on with reality. And this big clash of numbers, it all goes down in a very specific and temporary part of the accounting system.
That place is called the factory overhead account. Now, this isn't a permanent account like cash or inventory. A better way to think of it is like a temporary holding pen or a clearing zone. It's designed for just one thing: to hold all the actual overhead costs that flow in, and to square them up against the estimated costs that we apply to products as they flow out.
And here's a really simple way to picture how it works. On the left, the debit side. That's where we collect all the actual costs as they happen. The utility bill shows up, we debit it right here. A shipment of factory lubricants gets used, we debit it here. Then over on the right, the credit side, that's where we log our estimates. As we finish jobs, we use our POHR to apply overhead, and that estimated amount gets credited here as it moves into the value of our inventory.
So think about this for a second. We've got actual, real-world costs piling up on one side and our best guess, our estimate, being applied on the other. What do you think the odds are that those two sides will perfectly cancel each other out by the end of the year? Yeah, they're pretty much zero. That leftover balance, that imbalance, that's what we call a variance. And now our job is to diagnose what it means.
And there are only two ways this can go. On the left, if our actual costs end up being higher than the estimated amount we applied, we have what's called underapplied overhead. This is an unfavorable variance. Basically, it means our products didn't get enough cost assigned to them. But on the right, if we applied more estimated cost than what we actually spent, we have overapplied overhead. And that's a favorable variance, which suggests we were maybe more efficient than we planned to be.
And these variances aren't just some abstract accounting terms. They tell a story about what was actually happening in the factory. An unfavorable, underapplied variance, that could be a sign that electricity prices suddenly shot through the roof. Or it could point to a bigger issue, like maybe production was way lower than expected, so all those fixed costs, like rent, had to be spread over fewer units. A favorable, overapplied variance could mean the purchasing team got a fantastic deal on supplies. Or maybe that the factory was humming along at a higher, more efficient capacity than budgeted.
Now remember, that factory overhead account is just a temporary holding pen. At the end of the year, its balance has to be zeroed out. We can't just leave that variance sitting there. We need a treatment plan to deal with it. And there are two main ways accountants can dispose of this variance and get the books clean.
The first option is the simplest, and honestly the most direct. You take the entire variance, whatever the amount, and you transfer it to a single account, cost of goods sold, or COGS. This is a really common approach, especially if the variance is pretty small, what accountants call immaterial, which basically means the amount isn't big enough to really change how someone views the company's financial health.
So let's stick with our underapplied overhead example. This means the products we sold this year were undercosted. They didn't carry their fair share of the costs. To fix this, the adjustment is simple. We just increase our cost of goods sold expense for the year by the full amount of the variance. That one move zeroes out the factory overhead account. The big takeaway here is that the company's profit for the year takes the full hit.
But what if the variance is significant? What if it's a really big number? Well, then we need path number 2. This is the more precise, and you could definitely argue, the more accurate approach. Instead of just dumping the entire variance into this year's cost of goods sold, the proration method carefully spreads it across all the accounts where that original flawed estimate ended up. The best way to really understand this is with an example. So let's look at K's Custom Furniture. At the end of the year, they've got a big problem on their hands, a $150,000 underapplied variance. Their actual overhead costs were $1.45 million, but their POHR only applied $1.3 million to all the furniture they built. Now they have to figure out how to precisely allocate that $150,000 shortfall. So the first step is to play detective. Before we can figure out where to put the $150,000 variance, we first have to trace where the original $1.3 million in applied overhead went. So we look at the books, and we find that about 15% of it is still tied up in partially built furniture. That's our work in progress. Another 11.5% is sitting in the value of finished furniture in the warehouse. And the huge majority, over 73%, is already attached to the furniture they sold this year, which is in COGS. Then now that we have those percentages, the next step is just simple math. We just apply those same percentages to our $150,000 variance. This tells us exactly how much of that shortfall belongs in each bucket. The furniture still being built on the factory floor needs to absorb an extra $23,070 in cost. The finished pieces in the warehouse, their value needs to be increased by about $17,000. And the cost of goods sold for the year needs to go up by the rest, almost $110,000. And this all comes together in the final journal entry, which is really the crucial point. We increase the value of our inventory assets, WIP and finished goods, on the balance sheet, and we also increase our COGS expense on the income statement. This gives us a much more accurate picture of reality. Now, every single piece of furniture, whether it's sold or still sitting in the warehouse, carries its correct, proportionate share of the year's actual overhead. And just like that, the factory overhead account is finally brought back to zero. Okay, so we've spent a lot of time on the how, but the most important question is really why. Why does any of this even matter? Because the decision to either just dunk the variance into COGS or to carefully prorate it, that is not just some boring bookkeeping choice. It's a strategic decision that has a direct and measurable impact on a company's bottom line profit and the value of its assets. This table right here, this is the key takeaway of this entire explainer. Let's just focus on that underapplied scenario again. If the company chooses the simple method and closes the entire variance to COGS, their net income for the year takes the full hit, immediately. But if they choose to prorate, the hit to their income is actually much smaller because a big chunk of that variance goes to increase the value of their inventory on the balance sheet instead. And the opposite is true if they overapplied. Closing to COGS gives them a bigger, immediate boost to profit, while proration splits that benefit between profit and a reduction in asset value. And as this quote makes crystal clear, this choice is anything but neutral. It's strategic. A manager who wants to report higher profits and assets this year might prefer to prorate a large underapplied variance. A different manager who wants to minimize their tax bill might want to take the full expense hit right now by closing to COGS. These decisions can influence everything from the company's ability to get a loan to how investors see their performance. It's a choice with some very real consequences. So, we'll end with this question. Is a company's balance sheet hiding inefficiencies, or is it reflecting true costs? The answer, very often, lies in how they handle their overhead. Mastering this stuff isn't just about making the accountants happy. It's about a commitment to telling the truth. It's about making sure the financial statements reflect what's really happening on the factory floor, the good and the bad. Because that seemingly small variance in a temporary account, well, it's actually a window into the company's operational soul.